Hi, everybody. This is Dan Sheridan, and I'm going to talk a little bit on longer term butterflies. And we're going to look at the difference between a balanced butterfly and an unbalanced butterfly. I can give you some guidelines. We're going to look at the Greeks, but hopefully, this will give you a little bit better understanding of this type of a strategy. And again, I'm focusing right now, maybe 25 days out on this would be a balanced butterfly. Currently, SPX is around the 67, 76 area right now. And you can see that up there. And so we're just going to go at the money. And I'm going to use an iron butterfly that just calls and puts. You'll see here I'm going to sell a 167.80 call and sell 167.80 put. What's that called? That's a short straddle, selling it at the money call and put. So why would you do that? That's where the most extrinsic value is. That's the part of an option that decays the most. That's the most time premium there. And then for hedges, I'm going to go buy the 68.50 call here, 70 points above my short call. And I'm going to buy the 67.10 put, 70 points below my short put. So this would be called, in options vernacular, a iron butterfly. And you could use the same strikes and use a call butterfly or a put butterfly. It's basically the same graph. So this is a balanced butterfly. We'll get to unbalanced butterfly in a second, but this is going to be generally 25 to 30% cheaper than an unbalanced butterfly, and I will illustrate that. So it's basically, again, you're selling the at the money call and put, a short straddle, and you're just buying the hedges. Why would I do this? Because I want to get some time decay. And so if I want time decay, I'm going to sell the options that decay the most. What are they? Further, the at the monies will have your most extrinsic value. And then I'm buying my out of the money calls and put 70 points away, less extrinsic value. So you have this theoretical theta, $13. This is at the beginning of the trade. And again, this is not a 0 day. In this illustration, it's 25 days out. So your theta, that's your positive time decay. And it's just saying, because the 67.80s that I'm selling have more extrinsic value than my longs at 68.50 and 67.10s, I will get some positive time decay. My shorts will decay quicker than my longs. As we go from 25 to 24 to 23 days, you can see here, watch that theta as I get closer. If I go from 25 days out, as I go here, I'm 22 days, 11 days out. So I go from 25 to 11 days, the theta has kicked in. You're getting more theta as you get closer to expiration. So you could see the profit potential in the graph here, right? I just went from 25 days to 11 days. So we start out at 13 theta, but as we go closer and closer to expiration, it's like the sun rises. If you look at the green area profit, you're getting more and more theta as you get closer to expiration. Now, this is a balanced butterfly. So you can see, because I'm doing calls and puts, I'm just basically doing two credit spreads. I'm doing a 70 wide call credit spread, 70 wide put credit spread. I've received 2 credits. In this example, I'm receiving a credit of $6,190. It may change a little bit just because this is live prices. But what's interesting, the max loss is $810. You say, Dan, roughly how are they calculating your max loss or the margin? How much capital in your brokerage account would you have to put up? Well, I'm doing a 70 wide call credit spread, 70 wide put credit spread. So it's $7,000 is the width of the spread. So my margin would be $7,000 less the credit, right? So if the credit's like 61.85, my max loss or margin is 815. So you just take the width of the strikes, 70, less the credit, and your max loss or margin is $800. Broken wing butterflies or unbalanced would be about $1,200, and I'll show you that. Your max profit would be your credit if we closed exactly at your short strike at expiration. Now, you may be thinking, well, why is it more green if I'm balanced butterfly? Balanced meaning the distance from my short to my out of the money call, the distance from my short to the out of the money put is 70. It's balanced. Why am I showing more green on the downside when I start the trade and more red on the upside? Because just the nature of the trade, how the volatility skews and how everything works, you're starting out -2 deltas. What does that mean? It just means that for every dollar we go down, pretend delta is like short or a long stock. For every dollar we go down, we'd make $2, keeping the other variables basically the same. So if we go towards this expiration break even where the expiration graph in 25 days crosses zero, you say, I'm making money. How's that happening? Well, because most of the journey down here, I'm short deltas, short 2 deltas. So as we go down, I'm making money. It's like being short 2 shares of stock. Now, this type of butterfly, a balanced butterfly, you said, Dan, when do you normally do a balanced butterfly? Since we're here, as a quick overview, I'll do it when we have more down days, right? Because then I don't mind being a little bit short delta, right? You say, Dan, when in your experience is there more down days? When the VIX is probably over 17, 18, right? When VIX is 14, 15, 16, you're getting more up days than down days. We're in an uptrend. But when you get to 17, 18, 19, 20, you're getting more down days. So it makes sense being a little bit short delta. Now, in reality, as the VIX, as that goes higher and higher, this balanced butterfly, the deltas will get you a little bit less short. But either way, a balanced butterfly is a very strong butterfly for the downside. You can handle 200 points routinely. Now, on the upside, it just means early on in the trade, I may look to adjust this or fix it a bit. I can't wait as far, right? You say, what do you mean? You can see at the beginning of a balanced butterfly, if it goes way outside the break evens here, I'm fine. I can't do that on the upside early on in the trade. Now, as we go a little bit more into the trade, again, we're 25 days out. If I go even 1 week to 18 days, if I go 1 week into the trade, you could see there's a little bit less red here than there was at the beginning of the trade. Right at the beginning of the trade, you see some red here, and you see some red past the break even. But as you start going more into the trade, what do you notice? If we go from 25 to 8 days in the trade, a lot more green here because we've accumulated more theta. I can even handle a little bit outside the break even, but not early in the trade. Okay? So this is a balanced butterfly. Now, as you get towards expiration, you can see, yeah, more balanced. As you get close to expiration, your deltas will actually get a little bit shorter as we get to expiration. So again, I'm giving an overview of these kind of longer term 25 to 35 day butterflies. Now you say, Dan, when would I normally do these? Again, I like to see VIX for these balanced butterflies generally, preferably 18 or higher. Then we're getting more downside, and these are very strong, right? But most of the time, we're uptrending in the market, at least of the last year or two. And so a butterfly that can work well in a more of a uptrending market, I don't want to be 2 delta short. So what I would do is take the upper strike call, which is 68.50, right? We're 70 wide, 68.50 versus my short call of 67.80. I'm going to come in 10 points closer. Instead of 68.50, I'm going to make it 68.40. And what do you notice happens right away? My deltas go closer to zero. Instead of -2, I'm minus 0.4, but a half a delta short. So I don't get as much green as we go below the break even on the downside, but my red gets better on the upside, not as much because my deltas are less. Now, the nice thing also about the 70-60, you say, Dan, what do you mean again, 70-60? The distance from my short call to my out of the money call is 60. The distance from my short put to the out of the money put 67.10 is 70 points. So I have less risk on the upside, price risk, more risk on the downside, and we're starting this basically in the middle, right? So the unbalanced butterfly, this would be a 60-70. The width on the upside is 60, width on the downside is 70. It would work better when we're more upward trending. You say, when are we more upward trending? When VIX is 12 to 15, 12 to 16, you're going to get much more up days. So I use the VIX to kind of give me guidelines which butterfly I might prefer, right? So maybe a 12 to 15, 12 to 16. Ideally, I might prefer a 70-60. As we go, maybe we're starting to get a few more down days, 17, 18 VIX. I might use something called a Sherman Tank. What's a Sherman Tank? It's just a 70-65 is all that is. Let me show you that. Again, going to the call side here, what if I make it 65 up? So my short call is 67.80. If I take this and go 68.45. So 68.45, I'm not two deltas short of the balanced butterfly, but I'm 1.3. So now I'm 70.65. Again, my short call is 67.80. My upper out of the money call is 68.45. So there's 65 points difference there. My short put is 67.80. My long put 67.10. So it's a 70.65. I like that when VIX is more 17-18. But again, when we start getting over 18 to 19, I like to go to the balanced butterflies. They can handle the heat of the downside. Even if you get a 4, 5, 6, 7% correction, then I would go to back to the balanced butterfly. So that's kind of a general, kind of an overview how I look at longer term butterflies. I'd let the market tell me kind of which one to put on. And I use VIX guidelines to go along with that, whether I put on a balanced 70-70 or an unbalanced 70-65, I'll call a Sherman Tank, or a 70-70, which is a balanced butterfly. Now, I'm not in this video getting into risk management, how I would manage it, or how might I adjust it. But I think it's important to talk about these butterflies when they can be utilized. And, even if you're doing a lot of shorter term trades, it's good to diversify your duration, not have all your trades at a certain duration. So those are my guidelines. Yeah, those are the guidelines that I would use for putting on these type of butterflies. I hope that's a help to you. Thank you.